The stock market, a beginner's guide to a world of opportunity. Imagine a bustling marketplace, but instead of buying and selling fruits and vegetables, people are trading ownership in companies. This is, in its simplest form, the stock market. It's a vast, global network where buyers and sellers come together to exchange shares of publicly traded companies. This dynamic ecosystem is the engine of modern capitalism, allowing businesses to grow and investors to build wealth. Understanding how it works is not just for Wall Street professionals, it's a fundamental aspect of financial literacy for anyone looking to secure their future. At the heart of the stock market are stocks, also known as shares or equities. A stock is a small piece of ownership in a company. When you buy a stock, you become a part owner of that company. If the company succeeds, its value grows, and so does the value of your share. You can then sell your share for a profit. Companies issue stocks for one primary reason: to raise money. This process is called an initial public offering, or IPO. By selling shares to the public, a company gets the capital it needs to expand its operations, develop new products, or enter new markets without taking on debt. Think of it like this: a company needs a large sum of money to build a new factory. Instead of taking out a massive loan, it decides to sell 10% of its ownership to the public in the form of millions of individual shares. People who buy these shares are betting on the company's future success. If the new factory helps the company become more profitable, everyone who holds a share benefits from that growth. This symbiotic relationship between companies needing capital and investors seeking returns is what makes the stock market so powerful. The key players. Who's who in the market? To truly understand the stock market, you need to know the players involved. First, there are the companies themselves, known as issuers. They are the ones who sell the stock and whose performance dictates its value. Then there are the investors, the people who buy the shares. Investors can be individuals like you and me, or large organizations like pension funds and mutual funds, known as institutional investors. Their buying and selling activity is what drives the market's movement. The transactions themselves take place on stock exchanges, which are the central marketplaces for trading. The most famous exchanges are the New York Stock Exchange, NYSE, and the Nasdaq in the United States, but every major country has its own. These exchanges provide the infrastructure and rules for trading, ensuring it is a fair and orderly process. But how do individual investors access these exchanges? They do so through brokerage firms. A brokerage firm is a company that buys and sells stocks on behalf of its clients. You, as an individual, open an investment account with a brokerage firm like Fidelity or Charles Schwab, and they act as your intermediary to the stock exchange. Finally, there are the regulators. In the U.S., the Securities and Exchange Commission, SEC, is the main regulator. Their job is to protect investors and maintain the integrity of the markets by enforcing rules and laws. They work to prevent fraud and manipulation, ensuring that the marketplace remains transparent and trustworthy for everyone. How trading actually works: the engine of prices. The price of a stock is not arbitrary, it is a direct result of supply and demand. Think of it as a constant auction. The price at any given moment is simply the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. When more people want to buy a stock than sell it, demand exceeds supply, and the price goes up. Conversely, when more people want to sell than buy, supply exceeds demand, and the price falls. To trade, investors use different types of orders. A market order is a request to buy or sell a stock immediately at the best available price. This is the simplest and fastest way to trade. A limit order, on the other hand, is an instruction to buy or sell a stock only at a specific price or better. For example, you could place a limit order to buy a stock only if its price drops to a certain level. This gives you more control but doesn't guarantee your order will be executed. Market sentiment is often described using animal metaphors. A bull market is a period of time when stock prices are generally rising. The term bull comes from the way a bull attacks, thrusting its horns upward. A bear market is the opposite, a period when prices are generally falling. A bear attacks by swiping its paws downward. Understanding whether the market is bullish or bearish helps investors gauge the overall mood and make informed decisions. Types of stocks and investment strategies. Not all stocks are created equal. The two main types are common stock and preferred stock. Common stockholders have voting rights in company decisions and are entitled to a share of the company's profits, dividends, but they are paid after preferred stockholders in the event of liquidation. Preferred stockholders do not usually have voting rights but receive fixed dividends and have priority over common stockholders if the company goes bankrupt. Beyond this, stocks are often categorized by their investment profile. Growth stocks are from companies expected to grow at a faster rate than the average market. They often don't pay dividends, as they reinvest profits back into the company. Value stocks are from companies that are currently undervalued by the market. Investors believe the market price doesn't reflect the company's true value. Income stocks are from companies that pay high dividends, providing a steady stream of income for investors. When it comes to strategy, there's a big split between passive investing and active investing. Passive investors use funds like index funds or ETFs, exchange-traded funds, that hold a basket of stocks to mirror a market index, such as the S&P 500. This is a low-cost, low-effort strategy. Active investors, on the other hand, research and select individual stocks, trying to beat the market. This requires significant time, knowledge, and carries more risk. The right strategy depends on your goals, time horizon, and risk tolerance. Risks and rewards, the two sides of the coin. The stock market offers the potential for significant wealth creation, but it is not without risk. The main reward is capital appreciation, the increase in the value of your shares. This can be supercharged by compounding, where your investment gains generate their own returns over time. A small investment can grow exponentially over decades, which is why starting early is so crucial. Dividends also provide a steady income stream, especially for those in retirement. However, the primary risk is the potential for loss. A company's stock price can decline, and you could lose some or all of your initial investment. Factors like poor company performance, economic downturns, or even geopolitical events can cause stock prices to plummet. This risk is a natural part of the market, and investors must be prepared for the possibility of short-term losses. The most important tool for managing this risk is diversification. The old adage, "Don't put all your eggs in one basket," is the cornerstone of intelligent investing. By spreading your investments across different companies, industries, and asset types, like stocks, bonds, and real estate, you reduce the impact of a single poor-performing investment on your overall portfolio. Volatility is another key concept. It refers to the degree of variation of a stock's price over time. A volatile stock can see its price swing wildly, while a stable stock shows smaller price changes. While volatility can be scary, it also creates opportunities for savvy investors. Understanding and managing these risks is essential to a successful and sustainable investment journey. A real-world example and getting started. Let's walk through a simplified example. Imagine a company, Global Tech, just launched a new product and its stock is performing well. You decide to invest. You open a brokerage account online, deposit some money, and place an order to buy 10 shares of Global Tech. The broker executes your order on the exchange, and you now own a piece of the company. Over the next few months, positive news about Global Tech sales, paired with a general economic upswing, causes more people to buy the stock. Its price rises. You could sell your shares now for a profit. However, you've done your research and believe the company has a bright future, so you hold on to your shares, benefiting from their continued growth. This is the essence of long-term investing. For beginners, the first step is to open an account with a reputable online brokerage firm. These platforms have made investing more accessible than ever, offering easy-to-use apps and low or no-fee trading. Next, it's crucial to start with research. Read financial news, understand a company's business model, and look at its financial reports. You don't need to be a professional, but a basic understanding is key. Start small. You can begin by investing in just a few shares or a low-cost index fund. This paper trading approach allows you to learn without risking a lot of capital. The most important thing is to be patient, stay disciplined, and never invest more money than you can afford to lose. The stock market is a powerful tool for building wealth, but it's a marathon, not a sprint. The broader economic impact. The stock market is more than just a place for investors to make money, it is a critical pillar of the global economy. It serves as a vital economic indicator, often reflecting the overall health and future expectations of a country's economy. When the stock market is performing well, it typically signals economic growth and a positive outlook. Conversely, a sharp market decline can be a warning sign of an impending recession or other economic troubles. Furthermore, the stock market plays a crucial role in capital allocation and job creation. By allowing companies to raise capital through IPOs and subsequent stock offerings, the market provides the funding needed for innovation, expansion, and research and development. This influx of capital enables businesses to build new factories, hire more employees, and create new products, all of which contribute to a healthy, growing economy. The stock market is also deeply intertwined with our collective financial lives. Many people's retirement savings, whether in 401(k)s or pension funds, are invested in the stock market. Its performance directly impacts the financial security of millions of people. Understanding the stock market, therefore, is not just about personal investment, it's about understanding the engine that drives modern economic progress. Its history is a testament to human ingenuity and the power of collective investment to transform both individual lives and entire societies.